Have you ever wondered what separates the rich from the poor when it comes to money and finances? Well, it often comes down to the rules they follow. The rich use certain money principles that the poor simply don't know or use. Hello and welcome back to our channel. Today we'll be going over 9 crucial money rules that the rich understand and use to build wealth, while the poor remain unaware. By learning these rules, you can adopt the same habits and mindsets that allow the wealthy to grow their money. Let's dive in. Rule number 1. Pay yourself first. The first rule is to pay yourself first. This means making savings and investments a priority in your budget before spending money on other expenses. The rich treat savings as a recurring expense each month, automatically allocating a set percentage of their income into savings and investment accounts. This builds wealth steadily and effortlessly over time thanks to compound growth. But most poor people budget the opposite way. They pay all their bills first and then save whatever little is left over at the end, which usually ends up being nothing. Paying yourself first flips the script and makes you the priority. Start following this rule by setting up automatic transfers of 10 to 20% of your income into savings and investment accounts each pay period. That way, you save first before you can spend the money on something else. Over time, that percentage can increase as your financial discipline improves. The key is to make savings non-negotiable right off the top of your paycheck before your spending tendency kicks in. Out of sight, out of mind. This simple yet powerful rule lays the foundation for long-term wealth creation. Okay, on to the next money rule used by the wealthy. Rule number 2. Build multiple income streams. Next up, build multiple streams of income. Relying on one source of income like a job makes you vulnerable financially, but the rich mitigate risk by diversifying their income. The wealthy generate money from various sources like rental properties, dividend stocks, small side businesses, royalty income from intellectual property, and so on. Having multiple income streams allows you to earn money passively and continue earning even if you lose one income source. Following this rule provides stability and flexibility to better weather unexpected financial hurdles. To start, identify potential secondary income sources aligned with your skills and interests, whether it's investing in dividend stocks, monetizing a hobby, or investing in rental property. Experiment with a few until you find ones you enjoy and that yield consistent cash flow. Multiple income streams take time to establish, but provide the foundation for true financial freedom and stability down the road. Passive income is a game changer. Moving on to the next money rule of the wealthy. Rule number 3. Use debt wisely. Another money rule of the rich is to use debt wisely. They distinguish between good debt and bad debt. Good debt refers to borrowing money to purchase assets like real estate that can appreciate in value and generate income. Bad debt describes high-interest credit card balances and loans on depreciating assets like cars. The rich use debt like mortgages strategically to acquire assets that build long-term wealth. But the poor accumulate unproductive high-interest debt that erodes their net worth. To apply this rule, first establish an emergency fund. Then evaluate any existing debts and categorize them as either good or bad. Focus on eliminating bad debt completely, starting with the highest interest rates first. Once you're debt-free, you can then consider taking on good debt judiciously to invest if the opportunity cost makes sense. For example, a mortgage to acquire a rental property that will have cash flow and appreciate. With wise debt management, you can leverage borrowing to create wealth, but it requires separating productive debt from debt that destroys wealth. Now let's look at the next rule for minimizing taxes. Rule number 4. Minimize taxes legally. The next rule is to minimize taxes legally. The rich spend time learning how to optimize their tax liability through strategies like contributing to tax-advantaged retirement accounts to lower taxable income, taking advantage of favorable capital gains tax rates when investing, using deductions and tax credits to lower tax bills, and timing income and asset sales optimally based on current tax rates. But most poor people don't invest time into understanding taxes or seeking professional guidance, leaving money on the table. You can apply this rule by first learning about common tax minimization strategies used by the wealthy. Then consider working with a tax professional who understands advanced tax planning for your specific situation. Stay up to date on the latest tax laws and changes to capitalize on legal ways to reduce your tax burden over both the short and long term. Don't ignore taxes. Plan proactively. Now for the next rule. Rule number 5. Continuously invest in yourself. Here's another crucial money rule of the wealthy. Continuously invest in yourself through self-education and skills building. The rich devote time and resources toward learning new skills, gaining formal education, reading books, attending seminars, networking with leaders in their field, and more. This makes them more valuable and productive. Conversely, the poor often stagnate professionally and don't invest in their personal growth. To follow this rule, be a lifelong learner. Set learning goals each year. Read personal development books. Take courses related to your career. Attend conferences and training events. Get a mentor, and constantly expand your skills. Knowledge and skills drive income potential. Dedicate time each day to building your capabilities. Hone your craft, whatever your field is. Investing in yourself delivers the highest returns. Now for the social circle rule. Rule number 6. Surround yourself with like-minded people. The wealthy also follow the rule of surrounding themselves with like-minded people who inspire and motivate them to make smart money decisions. They build valuable social networks by joining mastermind groups, attending conferences, and developing mentoring relationships with those further ahead financially. This provides a support system and accountability. Compare this to the poor, who may stick with toxic social circles that reinforce bad money habits. You can apply this rule by networking with people focused on personal finance and investing. Join online forums, in-person meetup groups, attend conferences, and connect with those further along than you. Positive peer influence will rub off on you and provide encouragement, advice, and motivation to make smart money moves. Having the right people in your corner accelerates success. Let's look at the next rule around long-term thinking. Rule number 7. Adopt a long-term mindset. Another difference is the rich take a long-term approach to money, while the poor often just live in the moment. The wealthy set long-term financial goals, forecast into the future, and patiently watch their money compound over decades. But the poor rarely look that far ahead. Follow this rule by starting to shift your mindset to one of abundance and playing the long game. Create realistic long-term financial plans with saving goals for major expenses years down the road. This gives you clarity and helps inform smarter near-term money decisions. Think in 10, 20, and 30-year increments. Long-term wealth is created with consistency over time. Delayed gratification pays off big time. Now let's examine risk and reward. Rule number 8. Balance risk and reward. The rich also understand the relationship between risk and reward when investing, while many poor people avoid investing entirely out of fear. Smart investors use tools like asset allocation and diversification to balance risk and reward in pursuit of growth. But non-investors miss out on the long-run compounding only the markets can offer. You can apply this rule by objectively determining your risk tolerance and time horizon. Then create a diversified investment portfolio aligned with your risk appetite and goals. Don't hide money under the mattress. Put it to work in the financial markets. Understanding markets fluctuate, but reward long-term investors who stay the course. Learn to embrace calculated investment risk. And the final money rule, rule number 9, seek expert advice. Finally, the rich aren't afraid to admit what they don't know and seek professional advice around complex money topics. Hiring financial planners, accountants, and investment advisors provides helpful expertise. Conversely, the poor tend to overestimate their own money knowledge. They view paying for professional advice as an unnecessary expense, but expertise can unlock wealth. You can apply this rule by finding reputable financial professionals to optimize decisions for your situation. Understand what credentials like CFP and CPA designate. Vet potential advisors carefully first, but quality guidance pays for itself. Well, there you have it. 9 critical money rules used by the rich to build wealth that the poor often overlook. including paying yourself first, diversifying income, managing debt wisely, minimizing taxes, and more. Adopting these principles and habits practiced by the wealthy provides a roadmap to improve your own finances. Knowledge is power, so put these rules into action. Plus, if you found this video helpful, make sure to subscribe to our channel for more money tips and financial advice. Just click the red subscribe button below this video to subscribe to our channel. We release new personal finance content regularly to help you take control of your money.